Good morning, winners. Welcome to Terry's Tips. So guys, did you know that there's actually a way for you to purchase property literally regardless of your credit and sometimes even with no money down? Guys, today I'm going to explain to you what seller financing is. Get a notebook, get a pen, because seller financing is a creative financing strategy that many people just don't know about, but it's very real and a lot of investors use it, okay? So I'm going to explain to you what seller financing is, what are some of the pros and cons, and some of the terms that you need to be aware of when doing seller financing. Got it good, y'all. And if you are one of my newbies, welcome. My name is Terry. I am a self-employed entrepreneur, personal and business credit guru, investor, YouTuber, over 20 years of experience in my industry. I used to previously work for TransUnion. Guys, I upload brand new videos every Tuesday and Thursday morning. I would love for you to be part of our Terry's Tips community. All right, guys, so let's jump right in. So in a traditional kind of real estate transaction, what happens? There's a buyer, there's a seller, there's a negotiated price, and then you go to closing where ownership is transferred, right? And normally what happens is if you're a cash buyer, let's say somebody is selling their property for $100,000 cash. If you are a cash buyer, you are paying them that amount, over and done with, right? But most people sometimes need to do financing through like a hard money lender, through a conventional lender. So in that same scenario, maybe that person, you're selling a house for $100,000, you have the financing through a lender, and at closing, if there's a mortgage that needs to be paid off, if there's taxes that need to be paid off, all that's kind of taken care of at closing. The lender has the money to buy the property, then you're going to pay the lender back. Now, some of the kind of hurdles with that is that, when you borrow money from a hard money lender, from a conventional lender, from a traditional bank, you have to qualify for the mortgage, right? So that's where people have to worry about their credit and their student loans and their debt to income ratio and their taxes and their W-2s and their pay stubs. And so the barriers, people's credit scores, the barriers actually qualifying for the financing. Guys, seller financing is a way to acquire properties with no bank involved. Yes, y'all. So let me explain. So this is where with seller financing, same scenario. Somebody has a property they're selling for $100,000. Instead of you being a cash buyer, you're not a cash buyer, you're not giving them $100,000. And instead of you being somebody who's coming with loans, with a bank financing, you're not financing through a bank, you're actually financing it directly with the seller. The seller is becoming the lender. The seller is the one that you're actually going to pay back for the property. So it's called seller financing. Sometimes you'll hear it called owner financing. Sometimes you'll hear it called owner carryback. Guys, there's multiple reasons why somebody would do this. There's multiple benefits to the actual seller and obviously benefits to the buyer. One of the huge benefits to the buyer is that you don't have to qualify for the bank. You don't have to qualify for financing from a hard money lender or a conventional lender. And sometimes you can even negotiate putting like zero down. So your credit is not coming into play. There is no bank in this transaction at all. So what would happen is with seller financing, the person must own the property, guys. That's one of the things that you have to look for. The seller actually owns the property outright, okay? And so they're agreeing to sell the property to you and you're gonna pay them back terms. Now, why would a seller do that? A couple of reasons. So traditionally, if you're doing like seller financing, the seller is going to get a higher amount. So if it's typically a cash offer, you're going to pay a lower amount to give them one lump sum of cash. But with seller financing, usually, you can negotiate zero down or low down, but you're going to offer a higher amount for the kind of trade-off of you paying them directly. Guys, it's a win-win situation. And sometimes you as the investor help the seller see the benefit of financing you being kind of the bank for you because they'll get an actual higher amount. And guys, I want you to real quick think about the time in which I'm doing this, right? So this video is January 2021. We have our baby boomers who are kind of getting older in age. So sometimes they have properties, they're in the game. They want to get out of the game, but they don't want to lose that passive income. We also have estate sales. We have divorces. We have people who are, inheriting properties and they don't want to manage them. They're out of state. We also have people who need to relocate. So the key is finding motivated buyers And there's multiple reasons why somebody can be a motivated buyer. There's even people who own their houses outright but may have tax issues and could be at risk of losing the property or having other kinds of liens. And you doing something like seller financing is a win-win, where they'll get some income and you actually get the property. And guys, for seller financing, you actually will own the property. This is different than subject to. Subject to is creative financing if the seller has an actual mortgage. This is different than wholesaling, where you're just putting together a buyer and seller and you don't actually own the property. With seller financing, you are going to make the seller an offer and pay them in installments to own the property. And yes, ownership does transfer right away. So another reason why a seller would do that is because they're going to get interest. They're going to get paid extra money on your monthly payments. So let me explain. Let's say, you have somebody, and the 3 terms you really want to kind of look at is, number 1, the down payment. Okay. Number 2, the rate. And number 3, the term. So typically, okay, a traditional 30-year mortgage is going to be 30 years, right? So, but a seller, if they own their house outright, they may not want to wait 30 years for the actual, to do a term like that with you. So with seller financing, it will normally be a lower term, maybe 1 year, 5 years, 10 years. It can be negotiated, guys. It's a maturity date for this actual agreement. And this is where sometimes it's called like a balloon, right? So you can say to them, I'm going to give you, 5% down or 10% down, and I will pay this off in 5 years. They're getting some money right away, and they're getting monthly payments right away. And then it's still going to be paid off a lot sooner than, waiting, actually financing you for 30 years. Another thing is the down payment. So typically for like a seller financing deal, you may kind of negotiate maybe like about 5%, maybe a little bit lower. But let's say, think about your goals. What are you trying to do? If you are a flipper, right? Guys, listen to me. If you are a flipper, you may negotiating a higher interest rate to put 0 down because you're only going to keep that property a couple of months. So a typical, if you're going to be a buy and hold, right, you may want to negotiate a lower interest rate for a longer term. So for a buy and hold, you may say, I want to put 5% down and I'm going to pay this off in 5 years or in 10 years. And you put that 5% down, you actually start making payments to the seller right away. The ownership transfers. You are going to own this property. For a flipper, you may say, well, listen, I will pay 8% interest and I will pay the property off in a year and I want to put 0 down. Guys, for that, the trade-off to that is that, for a flipper, you don't care about paying the higher interest rate because you're going to pay it off. For the seller, they still get the benefit. They're going to get, the property paid off at the higher price, some money in their pockets, and it's going to be a win-win situation. So this is something that you can actually negotiate for them. Now, some sellers, they might want something from you, right? So this is where every situation is a little bit different. If the property maybe needs some work, guys, you can use that as leverage. You can say, well, I want to put 0 down. This property needs $15,000 worth of renovations. That's you can kind of leverage that as your skin in the game because the seller wants to know that you are actually able to pay for the property, are financially committed to this process. So you can say, well, I'll put 0 down, I'll pay it off in a year, and it's $15,000 worth of, renovations, and kind of leverage that. Your skin in the game is that you're doing $15,000 worth of renovations. You can honestly, sometimes if people are kind of weary about that, you can even put that money like in escrow or something of that nature to make the seller feel more comfortable about that. But this is where win-win situation. So you negotiate the terms, typically 5 years, but it's between you and the seller. You negotiate how much money down. This is where you can say, I want to put 5% down and I want to pay, 5% interest and I will pay it off in 5 years. No bank is involved. Win-win situation. The seller gets their house sold. The seller gets some money. The seller gets passive income, gets some money every single month, guys. And so this is where sometimes there will be people who have a mortgage on the property and they'll try to do this. Guys, I don't recommend it because for mortgages, there is a clause in there that can cause the bank to, the bank basically says, we are the lien holder. So during any kind of sale, we need to be paid first. And so if they find out about it, it could be sticky situation, could be legal stuff. stuff. They can actually foreclose on the house. I do know investors that kind of just, try to go for it anyway because they know they're going to pay it off quickly. I don't recommend it. Guys, the key is finding properties that are owned outright. And you may be saying, well, there's not many properties owned outright. False, guys. There's actually a ton of stats showing that usually about 1/3, like about 1/3 of the properties owned in the USA are actually owned outright. So this is where finding motivated buyers, networking, being somebody who's providing solutions, okay? So let's recap, okay? Seller financing means the seller owns the property outright. You are going to them directly to negotiate the deal. There is no bank involved, and you are negotiating with the seller to purchase the property. Now, this is where, again, I said, the 3 terms you want to be mindful of is number 1, how much money you're putting down. Typically about 5% is about average. You can, if you want to be strategic, say a higher interest rate to put low money down in a lower term. The other way is the interest rate and then the terms, guys, and you're paying the seller back directly. Win, okay? So it's just about having a conversation with people. That's really all it's about, especially if you see cash buyers, having them see the benefit of doing seller financing as opposed to just giving them one lump sum of money. And it's always, always, always higher than a cash offer. Got it good, y'all. Okay, and lastly, real quick too, for the actual paperwork. So, obviously you want to hire an attorney to do the contract. To be honest, seller financing is pretty typical, to be honest with you. So a lot of times even the title company can actually take care of some of that paperwork and contracts for you. But make sure all the terms are kind of spelled out and you guys are both on the same page. Be somebody who provides solutions. In this day and age, just like I said, a lot of times with the baby boomers kind of aging up right now, more and more people are looking for options, creative options to kind of, get cash flow, leverage what they have and to be a win-win situation. Hopefully that was helpful. Got it good, y'all. And real quick for my nugget. So guys, I want to simplify things. Success. There's only 2 things you really need to kind of focus in on. And number 1 is learning the rules of the game. And number 2 is doing it better than everybody else. Seriously, guys, stop overcomplicating everything. This is where, just learn whatever it is you're doing, whatever the niche is, whatever the business is, whatever the purpose is, learn it inside and out. Some people are doing 50 million different things. They're kind of mediocre and average at all of it. And that's why they're not having a ton of success. But then this is where, learn whatever it is you're doing, learn it inside and out, be a subject matter expert at something and then crush it, y'all. You don't have to be perfect at everything. This is where we always talk about team. There's no I in team. There's no successful entrepreneur as an island. You don't have to have it all figured out, but learn the rules of the game or whatever it is you're doing and then do it better than everybody else. That's it. That's how you become successful, literally. And then you teach somebody else how to do it as well and pull them up through the ranks. That's where the blessings come in from them sharing the information so somebody else can have success. Amen. So I hope that was helpful for you guys. Like, share, comment, and have a super amazing day on purpose.